What if I told you that in a single morning, Wall Street repriced both war risk and crypto regulation at the exact same time? That is basically what happened when markets flipped from fear to relief after President Trump said strikes on Iranian energy infrastructure would be delayed for 5 days, while the SEC and CFTC rolled out a major new framework for crypto. But the headline version misses the bigger picture, because this was not just a market bounce. It was a live demonstration of how oil, geopolitics, regulation, and digital assets are now deeply connected. The first half of the story is oil. When traders thought the Middle East conflict might intensify, they priced in a deeper supply shock. Then Trump posted that there had been productive conversations with Iran and that strikes on energy targets would be postponed. The result was immediate. Oil collapsed, stocks surged, and the Dow finished the day up 631 points. Brent crude settled down 10.9%, WTI down 10.3%, and earlier in the session, oil had fallen almost 15%. That is not normal volatility. That is a market ripping out a geopolitical risk premium in real time. The reason the reaction was so extreme is because the Strait of Hormuz is not some side detail. It is one of the most important oil choke points on Earth. The EIA says roughly 20 million barrels per day moved through it in 2024, equal to about 1/5 of global petroleum liquids consumption. So when markets hear possible de-escalation, they are not just hearing diplomacy. They are hearing lower shipping risk, lower energy inflation, less pressure on consumers, less pressure on the Fed, and better odds for economically sensitive stocks. That is why airlines, cruise lines, banks, and small caps jumped. Lower oil means lower stress across the system. Here is the catch. The rally was built on a fragile foundation. Iran denied that talks had taken place. Reuters later reported that the pause applied to attacks on energy infrastructure, not necessarily to all military targets. And by the next day, oil was already climbing again, while stocks turned mixed. So the correct read is not that the crisis ended. The correct read is that the market briefly priced in less bad news. In this environment, every headline can move trillions, because the underlying uncertainty is still unresolved. Now the second half of the story, crypto regulation. This is where the Fox segment points in the right direction, but the nuance matters. The SEC and CFTC jointly backed a new interpretation, saying there needs to be a clearer distinction between the fundraising transaction and the token itself. The SEC laid out 5 categories: digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. That matters because the agency is now saying many crypto assets are not themselves securities, even if they were originally sold in a way that looked like an investment contract. That is a major shift from the enforcement-heavy ambiguity of prior years. This is bullish for the industry because it gives builders a map. If you are raising capital by promising future managerial efforts, that offering can still fall under securities laws. But the token does not automatically remain a security forever. The agencies explicitly said a non-security crypto asset can separate from the investment contract once those promises are no longer what buyers are relying on. That is huge. It creates a pathway for projects to move from capital formation into commodity-style trading. At the same time, this is not deregulation in the purest sense. It is reclassification, boundary setting, and harmonization. So what is the real takeaway from this whole episode? The market is telling you that 2026 is being driven by 2 forces at once. First, geopolitical supply chains still matter more than many investors wanted to believe. Second, digital assets are moving from a legal gray zone into a more structured financial framework. One story repriced energy risk, the other repriced regulatory risk. Put them together, and you get a market that is no longer just trading earnings reports and rate cuts. It is trading infrastructure, jurisdiction, and trust. My view is this: the stock rally was a relief move, not an all-clear signal. And the crypto guidance was a breakthrough, not a final destination. The Iran story can still reverse on a single headline. The crypto framework can still evolve through rulemaking or Congress. But if you want to understand where capital is going next, watch the intersection of war risk, oil flows, and regulatory clarity, because that intersection is where the next big repricing will happen.